No? All right. Well, I'm going to hand it over to Bryan Jack. Bryan's going to be going over a little more in-depth analysis of the financial statement. And Bryan, I believe I have your presentation pulled up if you want me to go ahead and start that.
Yeah, that would be great. First of all, I want to say thank you to Ricky. That was a great job. You did a great overview of the income statement, its importance, and the different factors of it. While that's pulling up, let me just introduce myself, just like Christine said. I am Bryan Jack, the Bryan Jack. I'm an executive board member. As far as my background, I'm one of the few board members that don't have a background in investing professionally. I am a CPA. I am an accountant, received my undergrad and graduate degree in accounting, and have been doing that for about 12 or 13 years and have been certified as a CPA for about 10. So that's kind of a little bit about me. I love financial statements. So if you have any questions, definitely ask them as we talk about a few things. Everyone hear me okay? Am I speaking loud enough? Too loud? I'm good? Awesome. All right. Let's go ahead and go to the first slide. Okay, so my favorite quote from college was accounting is the language of business. And why do I think that's so important? Everything that a business does eventually runs through the company's financial statements. So think about it. Let's say Apple comes up with a new product. Well, they're coming up with new products every year. Well, they have some research and development, R&D expenses they've got to come up with. They have expenses to hire software, hardware engineers. They have a whole marketing team that they have to get ready. They have the whole assembly line that they've got to set up and get ready to go for their new product. So all of the costs that Apple is going to incur even to roll out a new product are significant. And obviously, as they're selling a product, they hope to recoup those expenses and make some money. Let's talk about another one. Christine, would you mind hitting there we go. Everything does. So let's say, for example, a company designs a new incentive program. Well, depending on how that incentive program is written, you can have employees do different things which impact revenues and expenses. Again, every decision, business decision, are we going to open up a store, on, downtown LA, or are we going to go open up on the East Coast somewhere? Every decision that a company makes has a financial ramification, for good or for bad, or sometimes they just come out in net zero. All right, let's go ahead and go to the next one. We're going to skip through this pretty quick. Christine, if you hit it one, we'll talk about the balance sheet. Think of a balance sheet as a snapshot in time. As of the end of the year, 12/31, we'll just assume their fiscal year end is the same as a calendar year end. Well, let's say it's 12/31. When you see a balance sheet that says 12/31, that will list the various assets, liabilities, and equity they have as of that date. You'll see a lot of companies do a lot in December. They'll do a lot of shuffling around to make their balance sheets look as good as they can for year end. But just remember, balance sheet is a point in time. 12/31, this is how much money we had in our bank account. Look at our bank statement and our bank reconciliation, and here it is. This is how much debt we have. This is how much we owe people in accounts payable. This is how much people owe us. Ricky did a great one on the next one with income statement. This reflects the company's performance over a period of time. And that's the biggest difference between balance sheet and the income statement. And the last one is the statement of cash flows. Identifies the sources and uses of cash. And it sounds like you guys are going to be diving into that a little bit more later. One thing that I wanted to point out there with those three, always consider two questions in your mind when you're looking at financial statements. The first one is, at what stage in the life cycle of the business is the business? Is it in its growth stage? Is it in the maturity stage? Is it in the startup phase? The reason why that's important as you perform different analysis and you look at the different financial statements, that's going to be a big difference. For example, a startup pharmaceutical company will have a ridiculous amount of expenses with research and development, but hardly any revenues. But once they get that FDA approval for whatever new, vaccine or miracle pill that they're going to come out with, until they reach that point, it's going to be all losses. Well, from an income statement portion, that looks horrible. But for other various reasons, you may want to invest that. Then the other one I wanted to mention is make sure you remember what industry you're in. So for example, 2 or 3 years ago, at the stock pitch competition in New York, there was a participant who was pitching a stock that had a ridiculous amount of debt. And a question was asked, kind of how do the levels of debt compare to the industry and that kind of things. Unfortunately, the presenter didn't know and kind of fumbled through an answer. But just remember, as you look at financial statements, what industry are you in? You'd expect a manufacturing company's balance sheet to look significantly different than a software company's balance sheet. Okay? So just remember those two things. We'll flip to the next one. So understanding financial ratios. This is probably going to be one of the most important parts that you're going to be doing for your presentation. And let's talk through why. So the first part is, which ones should you use? Section 3 of Module 5 has a great listing and a great summary of various ones. The most important part that I want you to remember, again, we're going to go back to it. What stage is the company in its life cycle? And what industry is it in? Between asking yourself those two questions, you'll want to pick out the most applicable ratios. For example, inventory turnover ratio is not going to be useful for a software company, but inventory turnover ratio is going to be extremely important for a manufacturing company. So just remember, what industry are you in and what stage of the life cycle are you in? We'll go to the next one. Are the ratios good, bad, or just plain ugly? Well, the classic answer in accounting is it depends. Again, what are the benchmarks in that industry? Is their accounts receivable turning over less than or more than? Well, let's say their account receivable turnover ratios, 30 days. So from the day they make the sale to the day they actually collect the cash is 30 days. Is that good or bad? Well, if you're selling medical supplies to a hospital, that's amazing because the days there is usually about 90 to 100 days is how slow hospitals pay. But if you're a tech company and you're not getting paid until 30 days, that's a cash killer. So remember what industry you're in. And let's look at the next one. Just don't get so myopic and looking at one specific ratio. Okay, financial ratios are there to help you paint a picture of the financial condition of the company. So just take a moment to take a step back and look at them all collectively. The last one is going to be a little trick that's not in any of the modules, but what I find to be a very useful technique to look at income statements and balance sheets. It's called common sizing your income statement and your balance sheet. So if you go to the next slide, you'll see an example of exactly what that means. So on the income statement, to give you a common sized income statement, what you do is you take every line of that income statement and divide it by your sales. Okay, so why is that useful? Well, it's really easy to tell that cost of goods sold in this example is 50% of your revenue. Your net income is about 32%. Your tax rate net of your revenue is about 8%. Why is this important? One thing that's really important to remember is financial ratios are for a point in time, okay? If we were to look at these ratios, compare them for 3 or 4 years, we'll be able to see trends. Their sales may be, growing 1,000% each year, which would be fantastic. But if their costs of goods sold is growing at 1,500%, so the cost of goods sold is growing quicker than their revenues are, well, you're going to see that gross profit start to shrink, and that's a bad thing. What's their SG&A look like as a percent of sales? Is it consistent? Is it decreasing? Is it increasing? Common sizing is very useful. I didn't grab an example of a balance sheet, but on the balance sheet, an example would be is you divide everything by total assets, okay? Again, you look inventory over total assets. Is inventory levels increasing or are they decreasing? And why? If you see a company that, their inventory is becoming a greater portion of their assets, and they're, let's take Apple for an example again, and they're trying to, sell iPhones. Well, pretty soon, if you have inventory building up, theoretically, you're eventually going to run into the point to where your technology is no longer up to date, right? It becomes obsolete. Well, then you start having losses and different things from your inventory, which is no bueno. So just remember, kind of look at multiple ratios on the balance sheet, on the income statement. Look at them over 3 or 4 years to kind of get a good picture, because you'll be able to see exactly what the company is doing. Okay, and the last tip that I had for you is don't skip the narrative. It's a pain to read and they're boring sometimes, but before the financial statements for public companies registered here in the United States, there's a long narrative section called the Management Disclosure and Analysis section, the MD&A. Essentially, this is where management of the company has the opportunity to add some color to the numbers. Hey, this is why this is going up. This is where we see it going. This is why this happened. We're looking at potentially these new agreements this year. There's a lot of meat in that. And it will also add color and add a little bit more information as to potentially why your financial statement ratios look different. Maybe they disclose, hey, we just patented some new process or product this last year. Now their gross margins are, they've grown by a ridiculous amount because their competition can't compete with that. And everyone's willing to pay a premium. So don't forget the MD&A section. So that's kind of all the little thoughts that I had prepared. I mostly kind of wanted to turn it over to you guys and see what kind of questions that you may have.
But on anyone's toes here, but I just wanted to ask Bryan, so how is the MD&A section different from the footnotes of a financial statement where you would have like disclosures on where these numbers are coming from, et cetera?
Yeah, it's a great question. So the notes to the financial statements are really there to explain the various line items in the financial statements, significant or different things that happened that actually impacted the financial statements. The MD&A could include some of that, but it will also include information that didn't necessarily impact any of the financial statements. For example, we'll go back to the patent idea. They could come out and say, hey, we've filed everything for a patent, to do X, Y, or Z, that we should start production next year. So it's another opportunity for management to kind of give non-financial information as well.
Got it. Thank you.
Perfect. So Bryan, I have a question in the chat. It says, how do you value intrinsic assets of a business?
Okay, value the intrinsic assets. So let's go over what an intrinsic asset is. So an intrinsic asset isn't something that you can like touch or feel, right? So a lot of these are generated when a company acquires another company for more than what the company is showing on their books for. A lot of that in the accounting world, it's called goodwill. You may have some other intangible assets, let's say a marketing company has some proprietary software that makes them just amazing, maybe some amazing algorithms that when they're purchased, they get purchased at a premium. Sorry, I got rambling. So how do you value them? So in accounting, there's something called an impairment test. So every intangible that you have has to go through an annual impairment test. All of that information will be disclosed in the notes to the financial statements. It may be as simple as there's no impairment. As far as coming up with your own independent value, it's going to really depend on the company and the situation that you're in, and how long that has been on the books. I mean, if it's been on the books for 5 or 10 years, it's going to be really hard to value. If it's recent, within the last couple of years, you can look at, see the incremental increase in revenues and different things like that in the notes to see if they give any other information. That's about the best advice I can give you on valuing intrinsic assets. They're hard.
Great, thanks, Brian. I have another one in the chat. Specifically for the stock pitch competition, what are some other questions that we should be on the lookout for when overviewing financial statements?
Oh man, I'm going to sound like a broken record. Go back to the 2 things. What stage of the life cycle is your business, and what industry you're in? Know your industry. You can Google financial statement ratios for software companies, and you'll see a Google list of those things. Those things are going to be things you're going to want to look at and study, and prepare a little bit. Like, for example, if you don't know that GE is drowning in debt and you're pitching GE, that's a bad thing. So just kind of make sure that's another thing that common sizing the balance sheet would help in looking at that. That's going to be your best bet, is what ratios apply to your industry. Know those, prepare a couple slides, and be able to speak to the inputs into those ratios as well.
Great, thanks, Brian. I have another one. What are some tip-offs in the financial statement or accounting policy that might indicate some financial shenanigans by the management team?
Yeah, that's a great question. So every publicly traded company that's registered in the United States has to have their quarterly financial statements reviewed by an independent accounting firm. And every year with their 10K, they need an independent audit. Usually it's done by the same accounting firm. In each of those, right before the financial statements, you're going to see auditor's opinion. Okay. If you see an opinion that says, it's called an adverse opinion, which means we don't think management has reported the financial statements accurately. That's a bad thing. Never invest in a company that has that. I personally have only read one like that. There's another thing that they can do, is they can do what's called a qualified opinion, which is essentially they take a step back and say, everything looks good, but this, okay? And they'll explain in an explanatory paragraph what's off or what doesn't look good. You will also notice, if you ever see in the notes to the financial statements something called a going concern opinion, what that essentially means is that's the CPA firm saying, a year from now, we don't think they're going to be around. So those are probably 3 areas where I would look that are going to be bright red flags screaming, don't invest in me.
Great, thanks so much, Brian. I have one last one in the chat. Is there a way to value competitive advantage?
That's a great question. Not really. Without being able to get more granular information, yeah, that's kind of hard. I mean, what you can do is on a higher level, you can say competitive advantage. Sometimes in financial statements, if the company's big enough, they'll have what's called segmented reporting, where, again, let's take GE. They've got their hands in almost everything. So looking at the financial statements really doesn't give you a lot of information, but if you look at their segment reporting and their notes, that gives you a lot more based off of their product line. You could do it that way potentially. Looking at gross margins, compared to other competitors in the industry, that may help as well. But actually coming with a hard value of what their competitive advantage is without more detail, you really can't from the financials.
Excellent. So there's no other question. If there's no other questions in the chat, and no one else has any other questions, I'm going to ask Rebecca if she has anything to add. Rebecca's on our regional advisory board on our East Coast. Rebecca, do you have anything to add?
Yes, I was trying to grab some of Brian's comments about and put them in the chat for everybody. And there was the third red flag. One was the adverse. Beware of adverse opinions. Beware of a going concern opinion. And what was that third one? I think it was
Qualified opinion.
Qualified opinion.
Yes.
So, you know, I think it actually goes. I was thinking about when Ricky was presenting, and you know, looking at the income statement as a video. What an interesting analogy. And that was great. Yeah, I'm not really too sure I have too much more to add to that. So it was, you know, those are, I think also looking at the notes, it's not just the management discussion. It is drilling down to the notes as well. That's where you will find, if you're going to find some red flags, if there are some red flags, chances are they'll be in there. The other question, the other thing that came up, but I think this was more on the income statement when Ricky was presenting, a hint about if there's a large amount of debt and long-term debt is if the interest expense is broken out. So that's something that may give you a hint that there could be possibly a large debt position in the balance sheet. So that was all I had to add. And I just thought, you know, Ricky, your presentation was great and some interesting perspectives. And Brian, thank you for some of those reminders.
Yeah.
Thanks so much, Rebecca. Brian, I had one last question. Have you ever seen a correlation in respects to the dollar amount a publicly traded company pays an auditor over time to potentially hide a company's shenanigans?
Now, this is a great question. SEC laws have changed recently. And when I say recently, I'm talking the last 10 or 15 years, where, you know, we had big frauds, Enron, Tyco, Waste Management. We had some big frauds. One thing that the SEC has now required companies to do is disclose the auditor fees. So when you pull up their 10Ks, you should be able to see, okay, last year we paid them $95,000 to do everything. This year we're paying them $180,000. I don't know if that's would immediately say, hey, you know, maybe they're trying to pay off their accountants, because it could have been, you know, back when Sarbanes-Oxley was introduced, there was a lot of consulting work that CPAs were doing to help companies put controls in. So there may be some consulting work there. But yeah, it would be something that may or may not. I mean, I don't think it's a direct, hey, they doubled the fees, they're paying them off, but maybe something to consider. Yeah.
Perfect. Thanks so much, Brian. Thank you guys for joining us this week for our YIS Global Online Club. And thanks for joining us, Christian.
Bye.